Good afternoon. This is Matt King, Chief Investment Officer at Bell Investment Advisors, and thank you for joining us for our webinar today entitled Mind Over Money Matters, How Our Psychology Reduces Investment Returns. Joining me today is Rohan Nayak, Certified Financial Planner and Investment Advisor at Bell. And in today's webinar, we'll be taking a look at the overwhelming evidence that suggests our psychological makeup and behavioral conditioning severely affect the returns we earn on our investments, and not in a positive way. We will explore the reasons why we can often be our own worst enemy when it comes to investing, and we will offer tips and tools to become more aware of these mental obstacles so that we, and ultimately our portfolios, can overcome them. As always with our presentations, we'll have a question and answer period at the end. You can submit questions to us at any time via the questions box on your GoToMeeting control panel. If you're experiencing any technical difficulties, try submitting those to us as a question and we'll try to help you online. And if that's not working out, you can call our office at 800-700-0089. So without further ado, I will turn it over to Rohan to get us started with the presentation.
Thanks, Matt. Let's jump right into it with this slide here showing the effect of fees. In our industry, there's a lot of focus on fees, and I'm sure that you've seen an illustration like this before. When looking at similar investments, fees make a big difference. You see on the slide here the Invesco fund in green and the Vanguard fund in blue. Both of these funds invest in the S&P 500. So you look at this graph and ask, so why wouldn't you take the cheaper option? Over 20 years, if the S&P 500 index grows at 7%, Vanguard investors will end up with nearly 25% more money just because of fees. The 1.18% difference has a huge effect over time. Clearly, fees make a big difference, with everything else being equal. And of course, I'm not telling you anything you don't already know. Now, what if I told you that there was something even more detrimental to investors' returns than high fees? That something is you, specifically your behaviors as investors. Each year, an investment research company named Dalbar releases an independent study that attempts to measure what the average mutual fund investor earned in terms of return. Now, just because a fund is up 10% in a year does not mean that all of the shareholders in that fund actually earn that 10%. If you held that fund from start to finish, you earned the 10%. But if you added or subtracted money from the fund at any point during that year, your return is going to be something different than their official fund return for that calendar year. Using mutual fund performance, inflow and outflow data that captures when investors buy and sell, Dalbar has been able to effectively estimate what the typical mutual fund investor earns in any given year. Dalbar has been doing this research since 1984, and what they've found is that the actual return earned by mutual fund investors differs substantially from what the mutual fund returns themselves and the broad market return. Now, as you can see in their latest report, which measures returns in the 30-year period between 1985 to 2014, they found that the average U.S. stock fund investor managed an annualized return of 3.8%. On that table, it's in the blue. This pales in comparison to the 11.3% return of the S&P 500 index and results in an average underperformance of 7.5% per year. And it's not just equity fund investors that are causing themselves to seriously underperform the mutual funds and the broad market. Dalbar also looks at how fixed income fund investors fare. What they've found with bond investors are similar levels of underperformance. In their latest report, which again measures returns in the 30-year period between 1985 to 2014, they found that the average U.S. fixed income fund investor managed an annualized return of just 0.7%. This pales in comparison to 7.4% return of the Barclays U.S. Aggregate Bond Index and results in an average underperformance of 6.7% per year. Now, these results from the Dalbar study are certainly stunning and perhaps difficult to believe, but it is a study that is accepted industry-wide and in the world of financial academia. And there have been other studies in the past that sought out to answer the same question. What do mutual fund investors actually earn on their investments? Now, one such study was performed by Morningstar from the 5-year period between 1989 to 1994. They took a sample of 199 growth mutual funds and found that the average return of these funds was just about 12% per year. Yet, when analyzing the timing of the inflows and outflows, they found that the average owners of these 199 growth mutual funds earned a return of just over 2% per year for a total average underperformance of nearly 10% per year. Now we can see similar conclusions from both Dalbar and Morningstar. Dalbar's conclusion, investment results are more dependent on investor behavior than on fund performance. While similar to Morningstar's conclusion, the return that the average investor realizes has more to do with investor behavior than investment results. We also wanted to share a more anecdotal approach. Now, Peter Lynch, who is one of the most legendary mutual fund investors in history, led his Fidelity Magellan Fund to a 29% annualized return during his tenure as portfolio manager. Now, during that time, the S&P 500 gained 15.5%, as you can see on this table. Despite this tremendous record of relative and absolute performance, Mr. Lynch has repeatedly said that his typical investor did much worse. And to quote him, over half of my investors in Fidelity Magellan during my tenure at the helm lost money due to poorly timed buy and sell decisions. Now, a lot of this has to do with how humans perceive and evaluate risk. I will turn it over to Matt to cover this topic.
Thank you, Rohan. So as mentioned, a lot of this underperformance has to do with how we evaluate risk, and this is simply how our brains are wired. This process of analyzing risk that we undertake has its roots back when we lived in the wild and were among animals and dangerous creatures, when our overall environment was very dangerous. Therefore, early humans developed a process of risk evaluation with the sole purpose of promoting survival. Early humans had to constantly assess if they were either safe or in danger. There were no degrees of risk. Because they had to make constant, rapid assessments of their safety, the number of choices had to be simplified, safe or in danger. Early humans did not have the luxury of performing research and analysis. In order to survive, they had to base their safe or in danger assessments on the data that was most forefront in their minds. And because early humans did not have the tools nor the time to conduct research in order to perform a proper probability analysis, they had to look for patterns in their daily life in order to gauge what was risky and what was not. Obviously, this process worked well because as a species, we are still around today. But of course, not all members of our species were able to enjoy long lives. Now, we generally don't have to worry about being eaten by large creatures anymore, but despite our evolutionary advancements, we still rely on the same risk evaluation process that our ancestors used. While this process of risk evaluation succeeded in securing our survival, it is a far from optimal strategy for assessing the risks of investing. Now, as we said before, our ancestors perceived themselves to be either safe or in danger, and investors are no different when assessing risk. When the market is going up, we feel safe. When it's going down, we feel like we're in danger. The result is buying into up markets when prices are already high and selling into down markets when prices are already low. Buy high, sell low. That's completely backwards from how it is supposed to be done. This pattern of behavior also shows up in monthly mutual fund cash flows, which by no coincidence seem to track the market's performance. When the market is up, money flows in. When the market is down, money flows out. If you look at some of the extreme outliers on the chart here, you'll recognize some famous dates in investment history. October 1987, Black Monday crash. August 1998, the Asian long-term capital management crisis. February 2000, that was the then largest monthly inflow on record, which occurred 1 month prior to dot-com stocks and the overall market crashing. September 2001, after the market reopened following the terrorist attacks. And July 2002, the then largest outflow on record, preceded the bottom of the market by just 3 months. And as you might imagine, the record outflow, as it stands now, from equity mutual funds occurred in October 2008 at the depths of the financial crisis and less than 5 months before the market ultimately bottomed. So clearly investors are not getting in or out of the market at ideal times. Instead, they're buying high and selling low. Our ancestors didn't have the tools or the time to collect data and perform analysis. Therefore, they had to base their assessment of risk on available data. And by that, I mean data that was most fresh and in the spotlight of their mind's eye. Something that happened 2 years ago would carry little weight, while something that happened 2 weeks ago would carry lots of weight. However, this process leads to something called the availability bias. Whenever an airplane has the possibility of crashing anywhere in the world, it is the lead story on the nightly news, whether it actually crashes or not. Plane crashes are rather rare, yet that is what is most immediate to us. On the other hand, car crashes are such a common occurrence that they are not covered on the news at all. But because they are out of sight, they are often out of mind. And that's what leads us to worry about our safety on our flight as we drive to the airport. The same thing applies to diseases. Heart disease is the #1 killer in the United States, but because it's so common, it doesn't make news. Rare killers like bird flu or mad cow disease scare people despite the low risk of contraction because every death makes the news, which leads people to worry about being the next Ebola victim while they enjoy bacon double cheeseburgers for dinner. This is the same reason why investors obsess about low fees while ignoring their own poor timing decisions. Investors are inundated with evidence of how fees are eating into their returns, and they're certainly good in that. Paying attention to the cost of investing is important, but relative to investor behavior, the costs aren't nearly as much. In the example at the outset of the presentation that Rohan described, investors are losing 1.18% per year in the more expensive S&P 500 fund. That is excessive, but it pales in comparison to what Dalbar and Morningstar calculate that investors are losing to their own poor timing decision. That's more in the neighborhood of 7 to 10%. But these studies don't get a lot of media attention, so it's out of sight and therefore out of mind. Thanks to the availability bias, the market environment plays a large role in investors' perception of risk. When the market is up and everyone is making money, like in the 1990s or mid-2000s, the potential for loss is virtually ignored and investors tend to underestimate the risk of stocks, which can lead to too much risk-taking. Conversely, when the market is down and everyone is losing money, investors tend to overestimate the risk of stocks, which can lead to investing too conservatively by holding too high an allocation of cash. or bonds. Investors seriously underestimated risks in the late 90s and mid-2000s because they were in a period of high returns and low volatility. After the bear markets of 2000, 2008, risk was much more prevalent in investors' heads than during the bull markets that led up to these bear markets. This led to investors into seriously overestimating the risk of stocks in the bull markets that followed each of these bear markets. We allow our recent experiences in the stock market to influence our perception of the risks. And as evidence of this behavior, the Vanguard Center for Investment Research asked a group of investors in 2003 the following question: what is the probability of stocks losing at least 33% in any given year? The average response was 51%. Investors thought there was a 51% chance that stocks drop at least 33% in any given year, but they were way off. Based on history, that probability is just 2%. A 30% loss in stocks happens, but it is an extremely rare event. The key to understanding why the surveyed investors were so far off, the right answer is the year in which the survey was asked, 2003. Investors had just experienced a 3-year bear market in which the stock market fell over 40%. After a recent experience like that, losses of 33% in a year seemed much more prevalent than they actually are. Now, this is the availability bias at work in our assessment of the risks of investing. Now I'm going to turn it back to Rohan to go over another interesting study that highlights why we come up so short as investors.
Thanks, Matt. So, along with falling prey to the availability bias, we humans also have a tendency to look for patterns in everyday life. When our world was much more dangerous, this helped with our evaluation of risk. If we could identify dangerous situations ahead of time, we could avoid them. Something to the effect of being able to identify which snakes are poisonous by the patterns on their scales, or which plants are edible based on their colors and leaf structure. And to this date, we continue with this behavior. Unfortunately, it pours over into our investment analysis. As evidence, there was a study performed where a blue light is flashed 70% of the time and a red light is flashed 30% of the time. Although the lights are flashed randomly, they adhere to this frequency distribution. Subjects are then asked to try to guess which color light is going to be flashed next, blue or red. In reaction, humans exhibit behavior that is referred to as frequency matching. In other words, we guess according to the frequency distribution. In this example, guessing blue 70% of the time and red 30% of the time. Interestingly, similar experiments have been done on different species of animals. Most animals display behavior that is referred to as maximizing. This involves guessing the most frequent occurrence all the time. In this example, the animals would always guess blue and never guess red. So, who's more accurate in predicting random events? Humans guess blue 70% of the time, being right 70% of the time, and red 30% of the time, being right 30% of the time, leading to an accuracy rate of 58%. Animals guess blue all the time, meaning that their accuracy rate is 70%. Animals are right more often because they use the optimal strategy. Outside of luck or cheating, you cannot be right more than 70% of the time. Humans perform worse because they're trying to find patterns when there are none. This leads them to think they can predict random events. Now, if you look at stock market returns over the short terms, they're also random. No one can predict stock returns over the coming year with any degree of consistency. But let's look at what we do know. Stocks go up more often than they go down. In fact, the frequency distribution of stocks going up versus stocks going down in any given year is about 70% to 30%, the same as the colored light experiment. So the optimal strategy is to stay in the market. Be like the animals. Just always guess your investment will have the up year. As long as the probability is more than 50%, and it's much higher than that, that's the best approach you can take. But that's not what we do. We think we can find patterns in charts like the one you have on the screen that leads to overconfidence about the direction of the overall market, short-term trading, and market timing, all of which have been proven to be detrimental to your long-term returns. Matt, any pointers on some things we can do or not do as an investor?
Yeah, we do have a few of them. So we certainly can't change millions of years of ingrained behavior, but we can take some steps to minimize it. First and foremost, stock investing is risky and volatile. There are going to be good days, good years, bad years, ups and downs, bull, bear markets. So you have to be comfortable with that before you get in. Otherwise, you will likely be forced out at a low point when you're scared and you think you're in danger. What's the downside of my investment? How much am I willing to lose? This is a conversation that we have with each one of our clients before they sign up with us, so we can understand the level of risk that's appropriate for them. And that's a good conversation to have with your advisor or with yourself. Secondly, you must be willing to lose principal. We come across many people who can tolerate losses as long as they don't lose the money they originally invested. But that's not the deal. That's not how it works. Stock investing may cost you principal. The market doesn't know when you got into the market or how much you invested. You could invest today and experience a few months or even years of losses before you start making money. So be comfortable with the idea of the possibility of losing principal. Otherwise, a more conservative investment than stocks would be appropriate. Now, stocks have not provided the best long-term returns by mandate. They offer these returns to compensate for the risk and volatility inherent in them. So you can't make equity-like returns without taking equity-like risk. It's also important to understand that short-term stock returns are random, just like the flashing lights. Give your investment ideas and strategies time to work. 1 month or even 1 year is not enough. We have had people tell us that they'll give us 1 year for our strategy to prove its worth. And the problem with that is that the fact that our strategy beats or underperforms the market in 1 calendar year says nothing about its worth. Managers or strategies produce value over time and not necessarily over the next few months. And any manager or strategy who happens to beat a market in any given year, it could just be luck. Time will tell. Now here are some action items, or in some cases non-action items, to improve how you manage risk as an investor. Pay attention to your behavior as it relates to your investment decision making. Treat it like any other cost that may reduce your returns, like investment expenses. Buy low, sell high. Now it sounds elementary, but your emotions will try to convince you to do the opposite. So it's something you have to try to resist at all costs. Invest for the long term. Many of the risks of investing are muted over time, and a long-term focus makes day-to-day volatility irrelevant. Like the animals in the colored light experiment, maximize. That means guess the market will go up. The market goes up much more often than it goes down. Because you don't know which way it'll go ahead of time, just guess up. The odds are in your favor as long as you have a long-term time horizon. And don't try to time the market. You may think you see patterns in the market, but you don't. Short-term returns are random. Don't check your portfolio every day. The more often you check your portfolio, the more often you'll see a loss. Avoid stirring up your emotions by checking your portfolio less frequently. Remember, you're investing for the long term. What happens today in the market doesn't really matter to your 30-year retirement plan. Lastly, Consult or hire a professional if you're not capable of handling this yourself, or if you don't have the time. Seek out the help. Like most investors, our clients get nervous about the market sometimes too, but when they are concerned, they call us. We are the buffer between them and their portfolios, and we can help them mitigate the negative effects of investor behavior on their portfolios.
Thanks, Matt. Now that concludes the presentation portion of today's webinar. A recorded version of today's webinar will be available on our website within a week. Additionally, all of our past webinars are available on our website, although only clients can access our quarterly investment committee updates. Our next webinar, held on October 21st at 2 p.m., is on October 21st at 2 p.m. The topic is still in development, but it will be related to financial planning. We hope all of you will be able to join us for that, and please help us spread the word. More information to come as we get closer to that date. We have a few minutes for questions. If you wish to submit a question, please type it into the questions box on your GoToMeeting control panel. We'll answer as many questions as we can, but if we don't answer your question specifically, we will get back to you with an answer after this presentation.
So we do have a couple of questions here. The first one is regarding the slide about Fidelity, Magellan, and Peter Lynch. Are those returns annualized or cumulative? They are annualized. I know it's tough to believe, 29% annualized return, but there's a reason Mr. Lynch is considered one of the best mutual fund managers in history. It was a good time to invest. He took advantage of the discounts in the late 70s and rode those through the 80s and had a 29% annualized return to show for it. Unfortunately for us investors, he retired shortly thereafter. The next question we have is, why do you think the financial media doesn't cover things like the Dalbar study that show how badly investors hurt their own returns? I don't say this to be cynical, but I'd say this as somebody who's dealt with the financial media. They're really in the business, like any of the media, of selling news. So they are looking for headline grabbing, sensational stories, and the narrative of Wall Street, being out to get investors with high fees and high frequency trading is a lot more sensational and sellable than having a story that tells people they're their own worst enemies. So that's just my personal opinion. I don't know the actual answer for it, but I figure it's something along those lines.
I think that's all the time we have today for questions. You don't need to wait for a monthly webinar or letter to stay in touch. We update our website with new content regularly, and we post daily market updates on Twitter. Also, Bonnie has a blog focusing on career and life coaching issues. You can find that at careerlifecoaching.bellinvest.com. And as always, if you have a question about your portfolio, please don't hesitate to contact us by email or phone. Lastly, today's presentation slides are available upon request. Thank you again for participating today.